little disclaimer on what it is. Give us just your high-level overview of the tool that we have in the platform.
It's a stress test your position. So we want to create something in the platform where a client can look at the positions and see, okay, what if something happens, right? What if the market goes down 5% or my stock goes down up 10%? Or what happens if implied volatility goes up? We want to be able to put those all things into a tool where you can kind of see, okay, assess the risk and whether, okay, I'm okay with the risk. Maybe I'm not okay with the risk. I want to do some stuff to offset the losses, right? So.
And what's cool about what you showed me yesterday is you can stress test your current filled positions from your positions tab, but you can also put on kind of hypothetical what if situations. Like if I put on this iron condor, let's throw this into the stress test and see how that might change and adjust my metrics.
Yeah, it takes in all your open positions, right? And then we can also create it where you do some what if scenarios, right? And they also tell you where the risk could be at in the risk raise.
Beautiful. Beautiful.
Let's jump to the next slide here. So when you're looking at kind of the features, and we're going to show this all, these are just kind of the ways that you can adjust all these inputs on the risk analysis tool. You can get all of your positions on the risk analysis tool. You can add new positions. There's also like a span margin feature where you can look at if you're using futures, you can see that sort of change as well. Just a little bit about this, and you'll be able to see both upside and downside in those changes. So the risk array is in both sides of the market. What happens if the market itself goes up or down a certain percent, as well as the changes in implied volatility.
Yep. And if you want to follow along while we go through these, to get to this view, to analyze this, you just go to your positions tab on the desktop app, click on the cap rec button in the upper right corner. And from there, you can click on risk analysis and follow along and kind of mess around with this as we go through it.
Good stuff. Let's jump to the next one here. So you can also change time inputs, right? So you have price, volatility, time. All these things can be changed and adjusted. You could do that for the portfolio as a whole, for new positions, or for specific positions. So you can change whatever sort of input specific to one position that you choose, correct?
Yeah, we're using an option pricing model. So we're taking those inputs in, current price, time to expiration, everything else into the model, right? And then generating what the theoretical gains or losses would be on at different price points. So you can see exactly what will happen, up 6%, down 6%, up 15%, down 15%. So you can see what the profit and losses are going to be. Like in JP Morgan, you can see that if we go down 15%, right, with a stock, right, I lose $6,000, but then I make $1,600 on the puts, right? So everything is getting offsetted as it gets aggregated. So you aggregate the gains and losses, right, to determine on each price point, determine what your exposure is.
Yeah, and from here you can use percentage changes, or you could use points. So that's another way that you can kind of differentiate how you're analyzing the total portfolio or the positions within the portfolio. And when you click that cap rec button, you can either include everything in your portfolio, or you can include specific positions that you have with those check marks before you click over to the risk analysis tab just next to it.
Yeah, nice part too is you can see we have price and IV, so you can update that yourselves, refresh it. You can refresh the prices. You can refresh positions. If you made a trade, you want to make sure it's into the risk analysis tool. You click on positions to make sure it gets added.
Yeah, so clicking on any of those buttons in the upper left, like price and IV, price, positions, if you click on those buttons, it just automatically refreshes it and makes sure that it's using up-to-date information.
Yep.
Very good. Jump to the next one here. So the next slide too. So we're looking at Greeks, I believe is our next one here. So you can also change and see what changes in your Greeks based on all these situations. So your delta, theta, vega, it'll show you how all of your positions change in those situations. So by hovering over, your specific
Position.
step, right? You call them steps. Like each of these, you'll see the 1, 2, 3, 4, and 5 at the top. It's basically, so if you have a 25% down move is what you're simulating. Each step is 5% down to give you an idea of like, along the way, what your risk or reward is on both sides of the market, but it'll show you your changes in Greek exposure as well, all along those steps going down.
Yeah, we want to make those steps equal distance for each other, right? And then, you can go in there, and if you want manually, you can also change it too on the left-hand side on the percentages. But yeah, and the Greeks part is we're calculating the Greeks for each position, right, based on the current implied vol, right? Mm-hmm. And then, also we'll also roll up to Apple for aggregate Greeks too. So take all the positions, offset the Greeks, right, and give you aggregate for the Greeks for each position too on the headings for the Apple.
Yeah, I think especially with portfolio margin accounts, it's important to understand how buying power can change with moves in the market, with moves in IV, and this kind of really helps you get a good understanding of how that might change in events that we're not foreseeing, like the Japanese yen unwind. That caused a lot of buying power changes with people that had bullish positions in the markets. This is something that you can kind of utilize to synthesize a similar move or something more dramatic or less dramatic.
Yeah, and a great price too is like you say the Theo price too. We're showing when we put these inputs into an option pricing model, right? Here's what your Theo price could be for the calls and puts, right? So the option pricing model is calculating, theoretical prices of your calls and puts to tell you, okay, if I sell that put at $1, it goes to $7, right? And that's the difference. That's how you figure out the gains and losses on the position, right? So that's kind of nice. You can see everything in there. So we want to make displays that are transparent, right?
Yeah.
It doesn't get any good if you do a stress test on a Monte Carlo model, 10,000 simulation. What's that going to do for you, right? What you want to do is be able to see yourself, right?
Call out Dr. Data and his Monte Carlos.
Well, he can come in and show all 10,000 simulations.
Yes.
But the good point here is that the clients can, see everything. Our models are transparent. And then they can do their own, what if scenarios, to see if they're comfortable with the risk or not, right?
Yeah. And I think like going back to an example that happened earlier this year, the Japanese yen unwind, I'm sure a lot of the conversations that were had on the margin desk were like, okay, I'm short this put in the E-mini futures, or I have this bullish position in the E-mini futures. My buying power has expanded. How can I mitigate this, or how can I hedge this risk? And that's where you can really bring in like, okay, if I buy this put 2 weeks out further out of the money, how is that going to affect my position? How's that going to affect my buying power? And that's where you can really adjust the Greeks and bring it in.
And let's jump to the next slide because that talks about that functionality. And so, one of the things that you can do is you can add in legs or trades up to whatever you can, up to 4 legs because that's the maximum order routing. But you can add on simulated trades or trades prior to you actually getting filled and placing them and getting filled on those trades and see how that will change or affect the risk parameters in your portfolio as you go along. So this is a really cool tool for, as Mike said, like if you're looking to hedge your portfolio, I want to hedge 10% down move or a 10% down move with a 20% pop in volatility. You can simulate that via this, risk array.
Yeah, to Mike's point, it's great for, clients calling in trade desks. They can send them to this tool so they can look at their risk, right, and stuff, in terms of they can see what their losses and gains are. And two is like if you have like in JP Morgan, if you have a hedge that's expiring today, right? Well, now you know to replace that hedge, right? So, to offset that risk, right? So what's nice about that is you can see what happens with your hedge. Oh, the hedge is expiring today. Am I comfortable with 10 grand of risk? Maybe I'm not, down 50%. So now I can replace that hedge, right? Mm-hmm. And then that kind of shows you how that reduces your theoretical losses.
Love it.
Let's jump to the next slide here. So for the price percentage changes, so you can look, the way you can look at this is that you can have them based on just all of them together, which is uncorrelated, right? So that's basically just saying across the board, everything is down 20%.
Right, move everything, the same price move for all symbols.
For all symbols. Beta weighting does it to SPY. So explain a little bit how that functions.
Yeah, so I mean, obviously, SPY, everything beta weights to SPY. Now we out function out. You can actually beta weight to other symbols too. In this example, SPY obviously is how everything is looked at, right? And so if you have a beta of 2, right, meaning that you have a high beta stock, right? So if the SPX goes down 10%, that stock will go down 20%, right? So all we're doing by providing the beta is like a multiplier for the stress. So you're going to say, okay, if SPX goes down 10%, you have a 2 beta, your symbol will go down 20%. We're going to show those 20% losses in terms of the stress test.
Yep. So and that's a really cool feature because it takes all of your positions, not only the size, but the correlation. So like it'll account for the fact that, gold and silver have a low beta,
right?
If any beta, positive or negative correlation as well to SPY. So it doesn't just, nuke everything 20%. That feature allows you to take your portfolio as a whole and puts it, together under beta weighting. That's why we always talk about beta weighting our positions and using that as like a risk metric. You'll see that in the risk array when we demo through.
And again, like we're talking about transparent, you can see the betas on the left-hand side, And if you want to change it, you can always change. You can change your stress test too. Like like the betas, you can change your price move right to where you think it should be. So which is nice. Same with implied values. You can go in there and change them separately too. So we made it so clients can make their own changes too. It's not just what we think everything should be. We're making it functionality, scalability, so you can do it yourself.
Yeah, you can really edit anything.
Right.
And you could get super granular. Like you can say
100%.
This position goes down 20% and volatility expands 10%. And you could say this one doesn't move. Like you can
right. If you have different options on different series, you may take down Jan Val. You may take up D's Val. Whatever you want to do it. You can do your own little changes on your Val, right, to see how that affects your option pricing model.
Yeah, and especially if you're using the beta weighted feature, you can, like we've talked about, it defaults to SPY, but you could change it to something like the Qs. Like maybe you think if there's going to be a big move in the market, maybe it's tech that leads that or drags the market down. You can change the beta weighted symbol from SPY to the Qs and see how those figures change.
Jumping over to the next one here, we're talking about the IV changes that you can do. Give me a little bit of a explanation between points and percentage.
Right. So we did it. We had 2 ways of doing it. One, you can do percentages. So if you move your IV 20%, it's going to move each individual option IV by 20%, right?
Yep.
Okay. IV shift is just moving everything that by the same implied val move. So let's say like VIX right now is like 15. Mm-hmm. Let's say we want to do like a 50% of the VIX, right? So let's say 7 points, 7.5 points. You can go in there and go IV shift and go 7 points. It'll move each one individual implied vowels 7 points. So your implied vowels are 30, it goes to 37. Okay. Your implied vowels are 40, it goes to 47. So there's different ways where you want to do in terms of how you wanted to program your implied volatility shocks, and so that's what we made it. So you have different ways of looking at it.
And again, you can do that as the group as a whole,
as a
or
global shift.
Each individual option. You can even get goofier and go and change, whatever option implied volatility you want.
Correct.
Specific option, specific position.
Correct. Yeah.
Really cool. Jumping to the next one here. So this is for points. So points, you gave us that already. So points does the position as a whole.
Correct. So it moves everything the same. So if you have Apple and Val or Tesla vowels, can move everything. If 7 points, can move everything 7 points.
All right, give us our takeaway. We'll finish up the slides and we're going to get right into it, and we'll give you your disclaimer so we make everything all kosher here. We try. So the Taste Trade Risk Analysis tool is designed to offer comprehensive and dynamic insights into your trading portfolio, allows traders to be their best risk managers. I like that. We have great ones here, but you should be a good one as well. It allows you better understanding of how different scenarios impact your trading portfolio and positions, and you can make informed adjustments to your positions to optimize your risk reward profile. Give me my disclaimer, and then we're jumping into the platform.
Lovely.
Fantastic. Again, if you got questions, put them in the YouTube chat. Mikey's going to be throwing those our way as well. But we want to show the platform and the feature itself. We're going to have you walk through,
Yep.
changing some stuff, adjusting some stuff. So we will do that once we get this platform up.
Yeah. While we work on that, David asking, what's the current Apex 40% down market multiplier today? Is it 5 or 6% of account net lick? Do you know what he's talking about?
So about a year and a half ago, they
Do you know what he's talking about?
I don't know.
That man knows everything. That's an encyclopedia with a mouth.
So OCC came out with stressing clearing firms. So there is a down 40% number they use for firms in terms of how much they have to put up capital, right? And so then since they hit us, and Apex had to trickle down to clients where we have to imply a 40% number to their portfolio, right? And then we get a function of their net lig to exposure. So, I think 6 or 7 ratio is kind of where we're at right now. So.
Cool.
There you go. David, you tried to stump the Schwami. Remember that? Remember that show? It was with
Johnny Carson?
No, it was
I don't.
Chris Berman.
Chris Berman.
No, whoop.
Oh,
whoop.
yeah.
Like he used to have a sport. I thought it was a sports show. Well, you didn't get him, but it was a good question. All right, so we're gonna get into it. So on the portfolio page on the platform, you'll see in the upper right-hand corner this capital requirement button. You click on that, and it'll give you your risk arrays here, all the things that you can change. You can pick which positions you want to include. You can have them all here, which is what I had selected. You can select specific positions. I just go in here, randomly click a couple. It'll show you only those positions. We're going to get into it here. We should have some fun with it and just use all the positions, but might lessen it if we have to. So when we get in here, give me a scenario and show me how to put that in here. Better yet, I'm going to give you a scenario.
Okay.
I want you to tell me and walk me through how we do that. So let's say the market goes down, or let's do our price change of 10%. We're going to say IV goes from a VIX of 15, which we're at right now, let's say 25. How would I make those adjustments and show me some of the things that I'd see?
So we would go into override, right?
Okay.
And click on uncorrelated. And we're going to make that 20%, right?
Okay.
So now that
So we're going to say everything goes down 20%.
everything goes down 20%.
Everything goes down 20%.
Right.
Okay.
Then we go IV shift. And now if we can do a couple things. If we wanted to go, we can move the IV shift points is 7 points.
Relative to the VIX.
Relative to, so 50, if you take a 50% move, right, so it goes to, you say 15 to
25.
25, so 10 points. So we can move it up 10 points,
Okay.
and then that will move all the implied values up 10 points on each one of these symbols. Or we can just do like a 20% move, however you want to do it, because 15 to 30, that's a big move, right? So, we can go up by 50% in case you want to do that and take the IV shift and go up 50% percentage moves.
50%.
Yeah.
Okay. So it's a big one.
That's a big one.
Okay.
So just going to take each individual implied val and move it by 50%. So if you have a 30 implied val, right, that goes to a 45%, right? So everything gets moved.
And this is looking at, on both, and each one of these positions, you can see the change in the profit or loss based on each of these moves.
Correct.
What's cool is that it gives you both sides of the market. Obviously, on an up, this implied volatility, if you were thinking that it was going to be an up move, there's no input to say like up 20% or down 20%. They give you both. If you were thinking that this was an up move, you would probably say that volatility wouldn't change here or would
Correct.
go down. You could adjust this to be down 10%, and that'll change your risk profile. You'd be looking on the right side of this risk analysis. So you can change both. The array shows you both directions of whatever your inputs are in terms of the market moving that direction. But it also gives you the upside and the downside for both those.
Correct. And if you want to make changes, like obviously indexes, right? We go up, the vol then it comes down, right? So you can make some changes to that, right? Because obviously in indexes, market goes down, vol goes up, right? So you can make those own changes too on that too. But yeah, you can go around there, make your own. What you think a reasonable one-day move is, right? Mm-hmm. So maybe a 5% move, 7% move, right? And then what's a reasonable implied volatility move in a one day, right? and then kind of put that in there. I think one of the next things we're going to go and have on there, we're going to actually take some historical dates and put into risk analysis. Like I was telling you that before, where we might take a 2020 COVID day, we might take the 2008 banking crisis. So we're going to have some historical market events, and we're going to put that in risk analysis to see how your position was done through those days. So we're taking those price moves and those volatility moves. So Dr. Data's got the data for me. So we're working on that.
So you'll be able to be like, give me a '08 crash scenario or COVID crash scenario,
Right.
automatically.
Yeah.
And that's really powerful because this is a complex tool, and it's like we've spent 5 minutes, 10 minutes here learning how to use it.
We haven't even scratched the surface.
Right.
There's so much.
And that's really powerful because a lot of people, like, we obviously don't know what's going to happen tomorrow or in a couple of days. Like, Jay Powell could go on today and say, oh, our 25 basis point cut that everyone was expecting, we're actually raising rates. Like, something could happen, the market goes crazy. But if you have a benchmark like the COVID crash or the financial crisis or whatever, now you can see, okay, my position's way too big, or, I could do this to hedge this risk if something like this were to happen. So I think that's really powerful.
And the other, you can also, I know you've shown how to simulate a trade too.
Yeah.
On the platform, you can also do that.
Let's add that in there too. So I was showing too that you can change the date of when this situation happens, and so I just moved this to like early January, just to show that as well. And the platform will adjust for positions like this natty gas position I have that's expiring in a couple days. It's gone, so it's off. It'll simulate all those things, like it'll take off positions that expired, or it'll account for the time change as well. All those things come into play here. Just going through those.
Yeah, we're just plugging those inputs into the option pricing model, and that's how we're getting the theoretical value of the calls and the puts.
Yeah. So why don't we go and let's see.
You want to put
pick one of your positions and throw on like a new position, and then we can bring that in. You don't have to get it filled. You can just put it on, and we can bring it in to simulate how that would adjust.
Okay, let's do like AMD. Put on a put spread there this morning. So we'll do the one I did for Johnny trades. We go to the cap requirement, and I'm gonna just isolate that position just so we can see it here. So the risk analysis, this is what I have on right here.
Yep. Then you have to add the trade in the upper right.
In the upper right hand corner, it's going to add whatever I just put on there as well.
So you don't have to send a trade.
You don't have to
send a exchange. You can go in there, create the trade here in the risk analysis, and look at it before you want to send it.
And so this is showing that short put spread that I just added on into the risk analysis. So it gives you an idea, and just to take that back, you could see, I've got a little bit of risk to the downside, obviously profits to the upside because I have some long delta there. If I add on this put spread,
you have to recreate it.
Oh, I got to redo it. I'm sorry. So if I go to the page, I put this back on, go to the cap requirement, add the order legs. You see now I have this downside risk because I'm adding a put spread to an already long delta position. It just adds in all the inputs that you're putting in that trade.
Yeah.
You can change all these. So I wanted to also isolate too all the things that you can change in the inputs. So if you hover over any part of this section, it'll allow you to change the price of the underlying. So I could make my own manual price change here, and let's say it goes to 97. Let's change that value. You can change the implied volatility of each option itself. You could do it of the whole thing, of all those options. Here you can see it's changing all those implied volatility. So all those things are at your will.
So we want to make some where you can make your own changes, right? We don't want some that's static, right? Here are the predetermined levels, right? We want clients to be able to be interactive and be able to decide what they want. And again, nice to know this, if clients have any suggestions they want to see, let me know, because we're always working to enhance our models. So if they see something they like to see in risk analysis, we love to see, what they think and everything else. So
I want to add so that we can, because I don't have that many futures. I just have a micro euro and a natty gas butterfly that's basically going away. So let's go in here and just put on a short put in ES and just see how that affects my portfolio. And we'll go into the span margin scenarios as well, because that's another cool feature here. So I'm going to go back here. I'm going to put my whole position in there. We're going to add the short put. So you can see it's obviously a huge effect on my positions because it's a big position relative to everything else. You have a short put in ES. It's much bigger position than my little Johnny trades that I have on here. When we go to the span margin scenario, can we add the new position?
No, it's got to be a fill position.
Okay.
But if you hover over it, I'll show you something that's pretty cool on our span margining.
Okay.
If you hover over the initial requirement, we'll break down to where it's coming from in terms of the span model. So you take your cursor and just kind of hover. There it goes.
We're gonna put it. I'm gonna just put on a put spread. So we'll do we'll do a wide put spread here, just so we can show this. So we'll do this wide put spread, out of the money put spread. We'll put this on. Okay. So when we go to the positions, we'll go to the capital requirements section. So
Click on report to refresh it.
okay, report. This will refresh it.
Yeah.
I got my auto refresh on there too.
Oh yeah.
So what can I change?
So if you hover over initial requirement with your cursor, you should see that. So it kind of tells you where it's coming from. So span has 16 different scenarios, and so
volatility, price.
Volatility, unchanged, up and down, and then price moves. So they basically
Time too, right?
well they take what a 1 day move would be. Let's say for ES is 5%, right?
Okay.
So they take 5%, and they move it a third, 2/3, 3/3. So they break it up into, so a full move would be 5%, then they break up into a third of 5%, 2/3 of 5%, 5%, and they apply I think a 40% implied vol shock to it.
Okay.
And then scenario 15 and 16, they take the price move was 5%, they times it by 3, so they become 15%, and they take a third of those of losses as a requirement. But we can break that scenario down through our risk analysis, meaning we have the inputs there to put into it to mirror what span margin we're looking at. But it's kind of nice. You can kind of tell from where it's coming from. Scenario 14, we know that's the full 5% move, right? And so we can kind of recreate that to show you where the risk is coming from.
And these are I want to try and put this on I'm going to make this a naked position because I want to see the crazy changes.
Do they account for limit up and limit down moves, or is that kind of like the same thing?
Yeah, I mean they have circuit breakers in place, right?
Okay.
I'm going to make this as wide as possible.
So we wanted to take out the black model of span and be able to put on risk analysis,
enough capital.
so we can kind of show how they're looking at it. So
Yeah. So just another nod to clarity and transparency around how these things are actually being calculated.
right.
All right, I want to make this wider so we can see just. I'm trying to do it with my limited capital on this account.
You're going to be putting a margin call right away, but
Yeah, well,
you guys here.
That's true.
Yeah.
You could in person. That's how they did it back in the day. You'd get Tony Batista, and he'd come to your door with a baseball bat. That was how they did margin calls back in the day. All right. So I got a wide put spread here in ES. What am I seeing?
And if you scroll down, if you go to the far right where those arrows are, it'll kind of tell you where it's coming from. So scenario 14 or 16 now, scenario 16 on ES. So that's taking the price move and moving it to 300%. Like I said before, it's going from taking say 1 day was 5% to 15%, and then they're cutting a third of that as those losses as margin.
So that's 3 consecutive 5%.
Yeah, so 15%. Yeah, so
15% in the market as a whole.
As a whole, right? So basically saying from 300% move means it goes from 5% to 15%. Take those losses, haircut those losses, and that's going to be a margin requirement.
And I think this is really important, especially I know there's some people that are, selling puts in E-mini futures. This will help you understand the true size that you can absorb. Yeah. If you're doing 1 or 2 contracts, but you're way over levered from a notional value standpoint, this will show you how much you can truly absorb. If you have a 1 day, 2 day move where it's down 10%, 15%, and you can't absorb that, then that's problematic, and you need to do.
So then if you
hedge.
Yeah, you can go to risk analysis.
Can I do this for MES? Well, MES.
Let's go risk analysis real quick. And
Okay.
then, so we should be able to see that on there.
On the capital requirement?
No, just go risk analysis
Okay.
and then just put on ES.
Oh, you just want to do ES.
Yeah, so
Okay.
take everything else off. See how close we are.
So we have the 20% down with a 50% pop involved.
Yeah, so take everything off and just make it a 15% move down.
Oh, I have AMD in there too. 15%. Okay.
And then take off the vol shock.
Okay. So we're going to do this at basically no vol.
Yeah, so so that's kind of how they look at it in terms of we have to take off AMD, but that's fine. Yeah, they're doing 55%, but they're only going to cut about a third of that for the margin requirement. So
And that's 50 is here.
correct.
What's this yellow box? I saw a question from.
So the yellow box is just basically it's just telling you where the larger loss is coming from. So on the risk array, we put the color coded, just telling the client, okay, where it's coming from step 5, right? So the client can see where the large loss is coming from.
And it does it. So like on this AMD position, at a certain point, because my position would basically be at 0, it basically tells you this position is at its max.
Correct.
If you have like spread trades, or if you're, long calls or long call spreads or whatever, and the market drops, those call spreads go to basically 0. There's no more loss after that.
Correct. So it's kind of nice. It was a way of us, we kind of like to make the colors more like a heat map kind of look to it,
Yeah.
So, clients can see it, and we want to make sure it's easy to see, right? Easy to read, right? So.